Perfect. Just before we begin, feel free to take a picture of the QR code in case you want to download the presentation. This QR code, again, will be up later on at the end, so in case you missed it. But yeah. So just a quick introduction to Preqin. So we're a research, data, and solutions providers focused very much on the alternative space, so everything from private equity to hedge funds. I cover the asset allocation research. We have a team of 15 researchers which produce about 150 reports a year, focus very much on illuminating the data that we provide, as well as providing context to any investors. And I appreciate everyone who stayed for this penultimate session. So when we talk to clients, one of the major, challenges facing clients as looking into 2024 is the inflationary environment, and that's been brought up a significant amount of times today. So I won't go into too much, but generally interest rates across the board relatively high compared to historical last decade, and it's been the major challenge across the different asset classes. We are seeing, obviously, some signs that inflation has come down, but it remains sticky, but some signs that central banks will look to reduce interest rates. But overall, we're not going to enter, I think it's most likely we're not going to enter the markets that we've seen in the past with those low interest rates, and obviously it has impact on private capital, where a lot of investments are financed through debt, and valuations have been propped up by those low interest rates over so many years. So I think we're definitely entering that new regime, and that's going to impact private capital. Preqin also produces private capital return indices across all of the different major asset classes out there. I put some here to compare with some of the performances of the public markets. So here we have the US public equities, some European emerging markets, as well as fixed income indices versus the private capital and some 60-folded portfolios. But if we can just focus on the right-hand side, so few year 2022, we saw public markets fall, minus 20% for a lot of the public equity indices. From a private capital's perspective, venture capital also experienced that fall, but private equity and some of the other asset classes managed to hold off any fall and deliver some positive absolute and relative returns in comparison. For 2023, we saw a rebound in the public markets. Again, relatively strong performance from private capital as a whole, except for VC, which continues to fall, and again, more negative sentiment about VC. Over the long term, if we again, you look at maybe the 10-year to focus on private equity, net of fees has obviously outperformed, according to our index, some of the public markets. But again, when it compares to VC, which has brought that down more recently over the last 2 years' performance, that has brought it down below the returns that we see in the S&P 500 total returns. We also try to engage with our investors to understand why they're investing in the private capital space. And if we look at some of the reasons they provide, hedge funds, the ability to deliver on diversification, lower correlation, and obviously higher risk-adjusted returns has been a reason. But we focused on the right-hand side chart there. Private equity and venture capital, very much reasons to invest, higher absolute return, as well as higher risk or adjusted return. In general, though, the perception is that private capital can deliver the greater diversification to the standard 60-folded portfolios that we've seen in the market that have dominated the market for a long time. For income generation, we look at the bottom half of that chart there, infrastructure, real estate, and as well as private debt were the asset classes selected for to help generate that income. Private debt has benefited from the floating rates and obviously the increased rates there. So some of the deals that we see in the double-digit, 10 to 15% in many instances. And real estate and infrastructure have some built-in mechanisms for inflation protections. Whether they work instantly, obviously is probably not the case, but whether they worked at all is also another question. But there is some element of inflation protection there. And one of the reasons, again, well, we're seeing a lot more allocation into alternatives, especially of late. Looking at our data, has been the correlation between U.S. equities and U.S. bonds. We can map this out for euro-denominated bonds and euro equities as well, and you can see a similar trend. But in general, higher correlation within the U.S. equity and bonds, up to a 25-year peak. And if you look at kind of how that, if you break it down maybe by inflationary cycle, we see correlation between bonds and equities go up when inflation is higher. So again, if we see that, if we see a sustained high inflation environment, then it'll be, you could probably deduce that the correlation will remain relatively high, and obviously alternatives can help deliver on some of that diversification in the portfolio. This is a stat which I quoted earlier, looking at the change in portfolio allocations across institutional investors in our database. So it's 2019 on the right-hand side and 2023 on the left-hand side. But what we're seeing across the board is an increase in allocation to alternatives, and who have been the beneficiaries of that: private equity in particular, infrastructure, real estate hedge funds, and obviously private debt as well. But it's not consistent across all the different types of institutional investors out there. So endowments, we see allocations up to 46% on an average weighted basis, so relatively high, kind of a leader in the alternative space. But then on the insurance side, we see kind of actually allocation remaining flat over the last 5 years at about 5% of allocation. And it really depends on, I guess, if you have liabilities and some of the regulatory environment and frameworks that they have to consider, especially around regulatory capital. From a fundraising perspective, how did we do last year? Well, it was not so good in comparison to some of the previous years. It was definitely a tough year. I think that's going to reflect it of the interest rates environments, some of the deals and exit environments that I'll talk about later. But in general, the only asset class that has managed to improve upon the 2022 fundraising targets was private equity. But in venture capital, infrastructure, and real estate, we see declines. And we obviously project this out as well into 2028 in our Future of Alts report, and we don't expect this to recover until about 2026, to the levels that we've seen in 2022 even. And this is a major factor and a big challenge for private equity and venture in particular. The deals, the number of transactions has fallen, both in absolute terms and in terms of aggregate value, as well as the number of deals. We did see a slight recovery in terms of the aggregate deal value in Q4 of 2023, but as you can see, it's very much a muted year when it comes to transactions, and this has created a significant issue of distributions within the industry, where LPs are obviously counting on distributions and not getting it with a slowdown, as GPs are not willing to perhaps take a loss on some of the companies if they had to create that liquidity to clients. From a more long-term perspective, what we're seeing in terms of the strategic asset allocation moving forward, three asset classes really are expected to receive most or a significant portion of the new capital. So that's private equity, infrastructure, and private debt. Today's panel on private debt, golden era, whatever you want to call it, is definitely been reflected in the data in terms of what's being raised and the performance so far as of this year and last year in particular. A big question there is obviously what happens when rates fall and increased competition from perhaps the banks, and if there's perhaps a impact on revenues of companies going forward, if there's any chance of recessions. Looking at infrastructure in particular, infrastructure has been a significantly strong performer across the long-term history that we have the index for, the highest Sharpe ratio in terms of risk-adjusted returns. So again, an asset class that's quite suited to the larger investors, which can invest large ticket sizes. And then private equity is still positive sentiment remains compared to VC, where we see the least sentiment. Hedge funds again also have some negative sentiment at the moment. We've seen some outflows, but again, it would differ by different types of strategies underlying that. One factor that's also impacting some of the changes in asset allocation, or maybe limiting some of the potential future increases in alternatives, is the denominator effect. So that's just the effect of other asset classes other than alternatives maybe experiencing a decrease, and so what happens is alternatives become a larger part of the portfolio by subsequent results without any actual increases in valuations itself. So that obviously might bring LPs close to their threshold and limits. And so what happens in this situation, this happens a lot, if there's greater volatility within public markets, then LPs tend to have a greater cash buffer, which might limit the amount that they'll invest in terms of into the alternatives in general. Perfect. Last chart now. Where do we see the market going in terms of AUM in the next 6 years? So we expect the alternative space to be about 24 trillion by 2028. That's quite a significant growth of where it was from an absolute perspective. In the previous 6 years, we saw tremendous growth, I think 16% on average across the different asset classes, but we're expecting maybe just 10% across the whole across all asset classes moving forward. And what's driving a lot of that is a combination of the increasing dry powder, the increasing commitments that we're expecting in the asset classes, and obviously the performance. And one thing to note is the only asset class that we expect to perhaps perform better than it did the last 6 years is private debt. But on the other asset classes, in terms of the capital market expectations, we predict that that's going to be a bit lower the next 6 years. So thank you very much for your time. That's all I have time for. If you've had questions, I'm happy to answer them later on. But again, here's the QR code for anyone who wants to take a photo of it. Cheers.